What stuck out to you in terms of fund flows in the last few weeks? Let's be a short-term viewer because people want to know what's going on.
Well, yeah, so over the last 5 weeks, we've seen 50 billion more flow into this market. That's been broadly leaning on U.S. equities and U.S. fixed income, which frankly, Bob, has been the story we've seen all year. We haven't really been able to see much on the international side, a little bit of emerging markets. Interestingly, emerging markets debt has been probably the best performing in terms of flows, part of the international ecosystem. So to the point of long-term investing, I worry that U.S. investors here have gotten a little over their skis in terms of home bias. It sort of worked for you because we've had such a strong dollar. But I think as we think about positioning portfolios for the rest of this year, we've got to be talking about international diversification.
Yeah, Dave was making a point. We have to be talking about international diversification at this point. So does this across-the-board decline in global assets that we've seen this year, does this strengthen the case for global diversification? And we've had this debate about China, that China should sort of be considered a separate case. There's people arguing out there that it's not sufficient to just invest by a country by market capitalization. Just because China is 20% of the world doesn't necessarily mean we should do that. That other metrics like values on democracy and capitalism should be taken into account. What's the right way to look at this global diversification story?
So we'll start with the value that global diversification brings, and I think especially when we look over the past number of years where we've seen that the S&P 500 has been one of the best performing asset classes, we're very quick to remember or to forget a period when the S&P 500 was on the weaker side of the spectrum, what we call the lost decade sometimes, from 2000 to 2009, where U.S. stocks were essentially flat for the decade. A globally diversified equity portfolio provided a meaningful return during that same period. And so I think right there is the case for global diversification. Now, how much you allocate to each country then becomes maybe a function of your circumstances. Market capitalization weights, a great place to start. China is certainly a large portion of the emerging markets portfolio in the world, but emerging markets is only about 11 or 12% of the global equity portfolio. Now, there might be reasons to deviate if you have a belief in scaling back your exposure to one country. And our investors, we have investment solutions available to them so they can customize their exposure to China in particular. There's lots of reasons why you might deviate from market cap weights, but it's a great place to start for a global diversified portfolio.
Dave, we've talked about this before. What's the right way to view this whole asset allocation issue? Is it more subtle than just market capitalization?
Yes. I think when you think about country allocations, you have to. I mean, we all know Perth Toll and the Freedom Index, FRDM is the fund, which explicitly excludes China and other countries that have human rights and other freedom issues. I think that's a reasonable approach, and we're seeing right now some of the activity, the negotiation going on between U.S. and Chinese regulators around audits. These are not wide open markets. It's not just a question of whether or not you support their policies. It has to do with the rule of law and whether or not you're actually doing the same thing by investing in a Chinese equity that you are in a U.S. equity. It's reasonable to have different metrics there and to reweight your portfolio to take into account some of that extra risk you get for being under China's thumb.